and welcome to Emmi's Climate 101 audio brief, where we break down the core concepts investors need to understand climate risk. In each episode, we unpack a key idea in climate finance, from carbon pricing and scenarios to financed emissions, WACC, and carbon credits, and explain what it means for investment decisions. Today's episode explores carbon credits and portfolio transition risk. Let's get started. So let's jump right in. We're talking about transition risk today. For an investor, what does that really mean?
It's really the financial exposure you have that's driven by tightening emissions rules around the world.
You mean things like the EU's ETS or Australia's safeguard mechanism?
Exactly. And all of that drives up the price of carbon. That price isn't just an environmental thing anymore. It's a direct, measurable financial risk.
Okay, so it hits the bottom line. How does that actually work?
Well, as those carbon costs rise, they start to squeeze operating margins. They can devalue assets, and they raise the cost of capital for any carbon-intensive company you're holding.
So how do you go from emissions data to an actual dollar figure? How do you quantify that future hit?
Right, you have to translate it. And that's the whole point of a metric we call potential carbon liability, or PCL.
PCL.
PCL, yes. It's an estimate of the value erosion your portfolio could face under a rising carbon price scenario. It's forward-looking.
So it's different from, say, a WACC score.
Completely different. WACC just tells you your current carbon intensity. PCL estimates your future vulnerability. And once you know your PCL, you can start to manage it. That's where these carbon instruments really come into play.
Okay, the instruments. Let's talk about those, because the terms credits, permits, it gets confusing.
It does, and it's a critical distinction. A carbon permit. Think of that as a regulated tradable license. It gives you the right to emit 1 ton of carbon.
And that's what's used in cap-and-trade systems.
That's the foundation of them, like the EU ETS. A carbon credit, on the other hand, is different. It's a certificate that represents 1 ton of carbon that's been avoided or removed somewhere else.
And that's why the difference between the compliance and voluntary markets is so important for risk management.
Absolutely. The compliance markets are legally binding. They're exchange-traded. That gives you the price integrity and liquidity you need for proper institutional hedging.
Whereas voluntary credits are maybe more for reputational goals.
I'd say so. They carry a higher basis risk. I mean, the risk that the credit you buy doesn't perfectly track the specific emissions risk you're trying to offset. For a financial hedge, you really want the compliance asset.
This gets us to a really important point, the dual use of these assets. And we should probably state the big caveat right up front.
Yes, we have to. Carbon credits are financial tools. They are powerful tools, but they are not a substitute for actual physical decarbonization.
You still have to do the work of reducing emissions in the portfolio.
You absolutely do. But with that in mind, they serve 2 incredibly valuable functions. First up is financial hedging.
All right.
If you hold compliance permits, let's say European Union allowances, as tradable assets, their value goes up as the carbon price goes up.
So as your carbon-heavy stocks lose value, the permits you hold gain value, offsetting the loss.
Exactly. It's risk management. It's diversification.
But isn't there a danger that firms just use this as a way to delay the hard work of actually cutting their emissions?
And that's why the second function is so important and why transparency is key. The hedge is insurance, not absolution. The second function is retirement and alignment.
This is where you actually use the credit.
Right. You retire a high-integrity credit to directly offset your finance carbon emissions equivalent. This improves your reported temperature alignment. It supports your net zero goals. It's a governance function. But a single permit can only do one or the other. It's either held to hedge or it's retired to align.
That dual function seems very powerful. I know you've seen this in action. Can you just briefly walk us through the Apostle Funds Management case study?
Sure. Apostle, they started by quantifying their baseline PCL. Then they modeled future carbon price pathways and applied a strategic overlay of compliance credits.
Like Australian carbon credit units, the ACCUs.
ACCUs, EUAs, yes. They use them as a pure financial hedge. It's a 4-step process, really. Analyze, model, apply the hedge, and then monitor.
And the result, what was the actual impact on the portfolio?
It was significant. They materially reduced their portfolio's potential carbon liability, that future value erosion, from 30.6% all the way down to 17.8%.
Wow. So that's a huge reduction in exposure just by treating carbon risk like any other financial risk.
It really is. And that's the key takeaway here. Managing your carbon exposure with the same rigor you'd apply to, say, currency or duration risk, it's no longer just an ESG preference. It's a fiduciary obligation.
Thanks for listening to Emmi's Climate 101 audio brief. Emmi Climate Risk, Built for Investors delivers financed emissions data, transition risk analytics, and climate-aligned portfolio diagnostics across all major asset classes. Our models translate carbon into financial impact, giving investors clarity and confidence in a fast-moving regulatory and market environment. To explore more Climate 101 resources and tools, visit emmi.io. Join us next time as we unpack another core concept in climate finance.